Although dividends are most frequently used, many multinational companies choose to repatriate profit from China via intercompany payments instead. Often, they attempt to achieve this by charging for supporting services, such as human resources, information technology, or financing, as well as intangible assets, such as trademark, patents, or know-how provided to China affiliates. In comparison with remitting dividends directly, profit repatriation through intercompany payments has advantages for some investors because there are fewer prerequisites, and intercompany payments are often an easier method. For example, the WOFI can make intercompany payments without going through an annual audit and annual tax reconciliation process. Further, the company can make intercompany payments when needed, rather than once per year for dividend remittance. Remitting money through intercompany payments is more tax efficient as well. Although the intercompany transactions are subject to value-added tax and a possible withholding corporate income tax, these intercompany payments can be deducted from the corporate income tax by fulfilling certain requirements. Despite the many advantages, profit repatriation through intercompany payments bears more risks for tax investigation. Chinese tax authority put special scrutiny on the intercompany service fees and royalties paid by Chinese enterprise to overseas related parties because they regard the practice as a tool for avoiding tax and shifting profits. This is particularly the case when the payment has a lack of business substance, when the payment is large, or when the recipient is located in a low tax jurisdiction. Separately, the tax efficiency of this method could be further impacted when the provision of service in China by the foreign enterprises is deemed to constitute a permanent establishment. In such case, the service fees will be subject to additional corporate income tax at 25% on a deemed profit rate of 15 to 50%. Royalty payments are subject to a 10% withholding tax. The statutory withholding tax rate of 10% on royalties can be reduced to a lower rate if a double tax treaty is applicable. Moreover, both service fees and royalties are subject to value-added tax. Under China's transfer pricing rules, intercompany payments are only deductible when they comply with arm's length principle. China defines the arm's length intercompany services as beneficial services transactions that are priced fairly according to the transaction conducted between unrelated parties under the same circumstances. There are two issues that need to be analyzed. First, whether the service is beneficial in nature. Second, whether the service is charged under the arm's length principle. For intragroup royalties, China's tax authorities hold the idea that profit derived from transferring or licensing intangible assets should be distributed based on the enterprise contributions to the value of the intangibles. That is to say, certain overseas related parties might not be qualified to receive royalties at all, or can only receive royalties to a very limited amount. Under this condition, companies have to maintain transaction documents as detailed as possible for demonstrating the authentic and beneficial nature of intragroup transactions in case they are challenged by the China tax authorities. This substantially increased the compliance burden to the enterprises. Compared with different profit repatriation methods, dividends are the most obvious and legitimate channel. However, China maintains a strict regulated system of foreign exchange controls, meaning that funds flowing out of China are tightly controlled. Other laws and regulations, such as the Chinese company law and the relevant tax regulations, impose additional barrier to dividend repatriation. Therefore, there are some prerequisites and barriers to prevent the Chinese investor company to remit the available cash as dividends. To remove dividend blocks, there are a range of optional options that multinational company can use to make it easier to repatriate profits, including intercompany charges, overseas lendings, and the sale of assets to generate immediate cash. Intercompany charges has less approval requirements and achieve tax efficiency, but it is subject to high transfer pricing risk and documentation requirements. Offshore loan can defer the withholding taxes on dividends, but is subject to high transfer pricing control. All of them need careful planning from both a legal tax and foreign exchange, as well as China transfer pricing perspective. In a nutshell, no method is one size fits all. You need to incorporate the profit repatriation strategy based on your specific circumstances, such as operational goals, investment plan, financial situation, and shareholders' preference to different risks. With a sound plan in place, companies can position themselves well in China to achieve their repatriation goals.